Coming up in today's show, stocks finish high to start the week but still on track for the worst month this year. China announces new measures in an attempt to rescue their falling market. The bond market's now pricing in probability the Fed will hike again by November. Some bullish and bearish arguments on the stock market. An update on gold and other commodities. And my short-only strategy reaches new highs. Welcome back to the Click Capital Daily Show, everybody. My name is Jared and I am back from a 2-week vacation. Thank you to all my loyal daily viewers for tuning in once again and sticking with me. I'm going to get you up to date on what has happened in the markets in the last 2 weeks, in addition to the normal daily update, and we'll take a look at where things could be headed next. So pretty positive day to start the week here on Wall Street. Bit of bullish breadth out there except for healthcare, which came off a little bit today. And just switching over to the 1-month performance heat map, you can see we have had a bit of weakness in the tech stocks, with Meta and Tesla both down over 10%, bit of weakness in the financials, and pretty much every other sector is down on the month as well, except for energy, which is holding up the best. And just looking at the charts, the market is pretty much unchanged. Since when I left for holiday on the 14th of August, we're about 44.80 on the S&P 500, we're at 44.33 today. The VIX was just under 15 when I left, and closed today just above 15. However, just taking you out to a monthly chart on the indices, we could be setting up a potential huge double top here, with the first top from late 2021, and then we could potentially be setting up the double top here on the S&P and NASDAQ as well. And if you've been watching the daily show, you remember back on the 27th of July, I called out this big bearish engulfing candlestick pattern here as being the exact same formation that we bottomed on back in October 13 when we did a big bullish engulfing pattern. So it looks like that bearish engulfing's played out in the short term with a short-term pullback. And it looks like the last week or two has been pretty messy here, chopping up and down. And one thing that did catch my eye while on vacation was NVDA earnings. So as we suspected, they come in with a blowout quarter, delivering $2.70 in earnings per share versus the estimate of $2.08, coming in just under 30% beat. And the market initially loved that, gapped up huge above $500 a share for the first time, but put in a huge dark cloud cover formation, which is pretty bearish there on huge volume. A lot of sellers stepped up and took advantage of that $500 price. And we're kind of just sitting here consolidating now. And just looking at the biggest stock in the market, Apple, it's done a little short-term bounce and consolidating. And just looking at our S&P 500 oscillator, that did manage to get into oversold territory, and we've done a little bounce off that now. And just looking at my sector trends table indicator, you can see most sectors are in a short-term bounce here above their 5-day moving average. However, I've got most of them below the 20-day and the 50-day. So that's one thing that's changed since I've left, is even though the indices are pretty much at the same level, same with the VIX, we've had a bit of a deterioration in breadth, now got most sectors below their medium-term average. And we can see that in other breadth indicators like the amount of stocks above their 50-day average now at 35%, still just a little bit above 51% above their long-term 200-day average, but we've had a bit of a breakdown in the amount of stocks making new highs on the NYSE, and the same on the NASDAQ as well, while the amount of stocks making new lows has been picking up on both the NY and NASDAQ as well. Another notable change since I've been on vacation was the rise in yields. Now got the Fed sensitive above 5%, and looking at the December Fed Fund futures contract, that just climbed to a new all-time high today to 5.5%. So that's just a quick look at what's changed over the last 2 weeks since I've been away. And stick with me, I'll run you through the most important news events and data, then we'll come back and dive into the charts. So we've got more troubles coming out of China. Their property sector keeps on going deeper and deeper into the red, with their former largest property developer, Evergrande, plunging almost 90% overnight in Hong Kong trading, and still being the world's most indebted property developer, posted a loss of almost $5.5 billion for the 6 months ended in June. And just adding more confirmation we are yet to see the bottom in the Chinese property sector. And this is just a look at the monthly chart of Evergrande Group. We can see they reached the low 30s a bit over 5 years ago, and here we are today trading at 35 cents Hong Kong dollars a share. And that's prompted the Chinese Communist Party to introduce more measures to try and prop up their market and shore up confidence and stop the onslaught of selling going on in their mainland stocks. Over the weekend, they introduced a new package of initiatives to support their stock market, including reducing required collateral and slashing a tax on stock transactions. They also asked their mutual funds to stop net equity sales, and they likely have their national team stepping in and buying stocks as well. And just looking at the China 50 index, after we went a bit short-term oversold last week, in their Monday trading, we had a huge pop. Did get up almost 5% in the session, but finished the day only up 1.5%. So it looks like investors took advantage of those high prices and sold that immediately. We heard from Fed Chair Jay Powell at Jackson Hole, and he said they're prepared to raise rates further to bring inflation down. And pretty much saying the same thing as he's been saying all year. Just going to rely on the data as it comes in. And looks like him and the market are still not sure when the end of this hiking cycle is going to come. And that's because core inflation is proving to be sticky. And I'm sure you and others are noticing that in the price we pay for our gas and petrol and food, whether at the market or out at a restaurant, definitely seems to be keep going up and up. So the stock market's hoping that we don't see a repeat of the trend in inflation that we saw in 1966 to 1983. And that's when inflation came in waves. We had increases in the late 60s into the early 70s. It came off, then we increased going into the mid 70s. It came off, then it increased again going into the early 1980s. So the stock market's really hoping this yellow line, which is 2013 until now, the last 10 years of inflation, just comes back down to 2% and stays around that level, and we don't see another upswing. However, Fed Fund futures aren't so sure, and this has been a big change since I went on vacation, because before I left, the market was pretty much pricing 100% probability the Fed's going to pause when they meet again in a bit over 3 weeks on September 20. They're now pricing a 21% chance they may hike then. And what's changed is the market had priced the probability that the Fed was already done. However, now we're seeing over a 61% chance that the Fed will hike in November, with the market even given a small chance to a 50 basis point hike by then. And I'd say that's what's making the stock market a little weak, along with a bit of seasonal weakness, profit taking after a great start to the year, and maybe starting to accept that higher rates for longer and not knowing when we're going to be done is finally starting to hit home for the market, especially tech stocks like we've seen in their month-to-date performances. Also potentially adding some weight to the market is student loan repayments starting back in October. After more than 3 years at 0% rates, during the pandemic-related payment pause, more than 40 million consumers will start paying a lot more back on their student loans, and that can't be good for discretionary spending. So the stock market's definitely in a short-term pullback. The question is, do we move into a medium-term correction? And zooming out again, are we doing a big double top on the monthly charts? Some are saying we're set up for a bit of a relief rally here. However, we have some other market veterans like Warren Buffett, who could be bracing for a recession by the fact that his company Berkshire Hathaway sold a net $8 billion of stocks, increasing its cash pile in the second quarter. We also got the big short Michael Burry opening up bearish option positions on the SP 500 and Nasdaq worth a notional $1.6 billion. And Warren Buffett's on his third consecutive quarter of net selling of stocks, increasing his cash pile by $38 billion. And the stocks he has been buying, like Occidental Petroleum, have been doing well since they dipped back in the middle part of this year. We've had a pretty good pop from those levels, as energy is the clear winning sector this last month or two. We can see that on our sector trends table. The oil and gas and energy, the only two sectors that are green on all time frames here. And staying with commodities, we've got gold, with the chief investment officer of Morgan Stanley saying they are buyers of gold on any weakness, and it appears resilient after a surge in real rates. And it's held up pretty well in the face of those rising rates and the US dollar, which is typically a pretty good headwind for gold. We can see that here. It's held these 1920 levels pretty good and just kind of consolidating this past couple of months below its all-time highs. Over to economic data, not much out today to start the week off. We are ramping up things a little bit tomorrow with the JOLTS job openings. Got some CPIs coming out of Australia and Europe, and then more inflation and unemployment data from Europe later on in the week, along with PCI and personal spending from the States on Thursday, and then the big one Friday, be non-farm payrolls from the States, with consensus being 150,000 new jobs expected to be created in the month of August, and that's what we're looking on Friday, the first day of September. And look at that, the fear and greed index finally lost its greed zone. Whilst I was away, now sitting down the bottom of the neutral zone at 47, and that looks like because of the options market has lost a bit of enthusiasm here. Pretty quiet day to start the week. Just over 30 million contracts traded and almost equal puts and calls. There's a look at the dark pool index in the blue line here. Still not showing much interest in the market at these levels, kind of just going sideways. And same with corporate insiders, still much more selling than buying going on. Okay, back into the charts and a look at the international stock indices. Had a pretty good day to start the week as well. But much like America, they have been in short-term pullbacks and just looking to find some sort of short-term bottom here. We have seen a pickup in realized volatility at the market after getting really low down at 8%, now tracking up to almost 12% annualized rate. Not much volatility risk premium in the market though, only 3 points above realized. Bond volatility still tracking sideways, but still pretty elevated relative to stocks, and we've been continuing to see that pick up and a bit of put buying and hedging going on in the market, with the skew index coming off a bit as well, down to 130. Looking at the growth versus defensive sector spread, that's been tracking sideways now. Same with high beta stocks and growth stocks versus value. Small caps continue to struggle a little bit versus large caps, but look to be finding support here. And commodities still in a short-term uptrend versus stocks. There's inflation expectations still climbing higher, and the 10-year government bond yield still an uptrend as well, now at 420. As higher rates are keeping downward pressure on bond prices, and we've still got high yield bonds tracking sideways. There's a look at the dollar index, almost at 104, just coming up to this resistance zone here. And Bitcoin had a big fall while I was away. Did hear news that Elon Musk's SpaceX dumped the crypto, and we seem to be getting these big moves and really tight volatility. So it looks to be finding some sort of support at 26,000 here. There's a look at the commodity complex overall as represented by DBC, Commodity Index Tracking Fund, and that's holding up pretty good in the face of those higher rates and a strong dollar. We did get a little pullback in crude as expected after hitting this resistance zone, but looks to be holding its 50-day VWAP here. And there's agricultural commodities, still in a medium-term uptrend. Over to stock sectors, and meme stocks have been hit really hard this month. Cannabis stocks still struggling, waiting to hear more from the government whether they can pass Safe Banking Act. There's a look at the AI bots ETF and some pretty messy price action in the semiconductor ETF. And just looking at a monthly chart on the semi, setting up an epic double top formation as well. It was pretty much green across the board for sectors out there today. There's a look at energy doing the best out of all of them, and the only one off today slightly was utility, still pretty weak here. Popular stocks, BlackRock still on a short-term downtrend, and the biggest stocks out there, mega cap tech, still looking a little soft here. There's Microsoft, Google. Amazon looks to almost fully lost its earnings gap. And the big one, NVDA. When I first saw earnings come out, and they absolutely smoked them by almost 30%, which was even a bigger beat than their last quarter when they beat estimates by 18%, and we gapped up and held by 24%. Like I said, the market gapped up above that big psychological level 500 and then pretty much finished unchanged. And we're still trading a bit below that here today. However, it looks like there could be a bit of dip buying going on, and I think this will be key for the market. Because remember, this year the market's really been led by this AI hype, with NVIDIA at the front of that. And so if NVIDIA can hold and it reclaims 500 and continues on, then that will really help the market psychology and sentiment. However, if NVIDIA were to fall apart after having that huge earnings beat, then that's really not a good sign for the market. And I'd say these higher rates are playing a big factor into that as well. Let's look at Tesla, still on a short-term downtrend. Similar story, and Meta as well. Over to meme stocks, pretty mixed today. Seeing AMC get absolutely hammered again, as all their financial engineering doesn't look to be paying off. Carvana still trading really strong. However, most other meme stocks pretty weak here. Active today was 3M, up over 5%. On news they're going to settle all their litigation to do with their faulty earplugs. Market really liked that. There's Carl Icahn's stock. Looks like he's still getting a taste of his own medicine. Stock now trading under $20 a share. And regional banks still holding up pretty good, except for the big guys. Bank of America, Citigroup a bit weak, along with Wells and Charles Schwab. And just before I finish out the day, here's a quick look at my strategy on the Collective 2 marketplace, where you can follow strategy developers. And my strategy on there only bears, formerly known as equity long short, only takes short positions, always has 20 short positions open. Combination of short-term swing trades and medium-term tactical positions. Just recently hit new all-time highs, currently up 18%. Year to date, significantly outperforming the S&P 500. And this is an anti-beta product and makes for a perfect hedge and complement to most long-only portfolios out there. And we've just had a short-term pullback in the market and we're already significantly outperforming. So you can imagine how well this will do if we do get that medium-term correction or resumption of the bear market, and that double top on the monthly charts does play out. If you want to learn more about this strategy, click the link below this description and you can see how you too can follow along or have this automatically traded in your Interactive Brokers account. Other than that, that's all I've got for you to start this week. Thanks very much for coming back to Click Capital. Truly appreciate you tuning into my daily show. It was good to have a holiday. I'm feeling refreshed now, back in the saddle and ready to report to you guys every day what's going on in the markets and where the opportunities may lie. Thanks very much and see you all again tomorrow afternoon. Cheers.